Hey guys, Davis here. Okay, so in this video, let's talk about selling put options. More specifically, let's talk about whether selling put options is safe or risky. Because on one hand, you have people saying that, they make thousands of dollars each month selling put options. Especially there are a lot of YouTubers, they will say that they make a lot of money selling put options. And there are people saying that if you want to get consistent income, you should be selling put options. And you also have people saying that you can get rich by selling put options. But on the other hand, you have people that got into a lot of trouble selling put options. Like they said that they got into a margin call and they blew up their account selling put options, or they lost all their money because they sold put options. And some would say that selling put options is extremely risky and that you should never sell put options. So which is which? Is it safe or is it risky? Well, let's really dive into this so you get a good understanding about what selling put is all about. So, in order to understand the risk of selling puts, we have to compare it to buying shares, because after all, if you don't sell puts, what are you going to do to invest in the market? The other alternative will be to buy shares. Okay, so this is Amazon. So let's say that this is the price. $100 is right now where you plan to buy this stock. Okay, you might be thinking that this is a good price to enter, so you want to enter at this $100. So what we're going to do is that we are going to buy 100 shares at $100. All right, at the same time we're going to simultaneously also sell one put option with a strike price of $100. So what we're going to do is we're going to compare these two. So when you sell the put, you receive a credit of $2.50. That means you receive $250 premium received. So now let's assume that the stock went down to $80, right? Because after all, the risk is all on the downside. So if it goes down to $80, the question is, what is the risk? How much does the 100 shares lose and how much does the short put lose? Okay, so let's take a look at the risk profile for this. So on this side, you can see this is the risk profile of 100 shares. Right, very straightforward. You buy 100 shares at $100. What is the amount you would stand to lose if it goes down to $80? So as you can see down here, very straightforward. If it goes down to $80, your loss will be $2,000. That is because it dropped $20 from $100. So $20 per share times 100 shares, that is $2,000. So if the shares lose $2,000, how much do you lose when you're selling puts? So if you can see, this is the short put graph. All right, so the short put, this is at expiration. This is how much you stand to make or lose. And this is right now, each day as time passes, this curve down here will slowly go up to match this curve. Okay, so at this point of time, let's say if the market was to immediately drop to $80, this is what the purple line you'll be looking at. So when it drops to $80, what you'll be losing, if you can see down here, is $1,827, right? And expiration, you will lose $1,750. So this is the box that you take a look at. This is the risk profile. So if you notice, you actually are losing lesser than buying shares. You see, if you buy 100 shares, you'll be losing $2,000 if it goes to $80. But when you sell the short put, you're actually losing lesser. And the reason is because you already collected the $250 in credit. So this amount that you receive, this premium, actually helps offset the risk that you would have on the downside. So let's take a look at this. What if the stock goes to $0? How much do you lose? What's the risk? So if you were to buy 100 shares, immediately you could see that the amount that you lose is $10,000. Let me just highlight it here for you so you can see. So it's $10,000 down here. Well, that's because you bought 100 shares at $100. If it goes down to $0, you lose $100 per share. That's $10,000. But for the short put, look at this. You only lose $9,750. And I don't mean only by that's having little money. What I'm trying to say is that you're losing lesser than buying shares. So if you notice, the risk is actually lower than buying shares. So selling puts have a very similar risk profile to buying shares. In fact, you lose less selling puts, which means selling puts is actually less riskier than buying shares. So if selling puts is actually less riskier than buying shares, then why is it that people are saying that, selling puts are risky and that people are blowing up their accounts and they're getting margin calls and they're saying that you should never ever get into selling puts ever again? And the answer comes down to this picture right here. By the way, if you've been enjoying this video so far, I'd appreciate it if you just hit the subscribe button and give a thumbs up so I can create more videos like this for you in the future. Alright, back to the video. So, as I was saying, the reason so many people blow up their accounts and get margin calls is because of this number right here. So this number right here is the main culprit. Alright. So what is this number? You notice it says this is the buying power effect. So essentially, this number down here is the margin you need to put up for just selling this short put, right? So for example, if you were to buy 100 shares at this price, $100, the amount that you need to put up to buy these shares will be $10,000, as we already know, right? But if you were to sell the short put, you actually do not need to put up the $10,000. All you need to do is just put up $1,000 and you could sell this put option and receive $250 in premium. So here is where the problem really lies. Okay, so imagine this: a lot of people, when they get into or when they get started selling put options, they'll generally start off with a smaller account. So let's say they have a $5,000 account. Okay, so they have a $5,000 account, and then they take a look at this number down here, which says that, hey, you only need to put up $1,000. All right, let's round this down to $1,000. So they say you only need to put up $1,000, and you can get $250 in credit. So they go and they start to think themselves, say, hey, if I've got $5,000, that means I can actually sell 5 of these put options. If I sell 5 of these put options, how much premium will I be able to receive? Right? So they have $250. They times 5, and the amount of credit or premium which they'll receive is $1,250. So they'll think to themselves, oh wow, that is a lot of money, because your account size is only $5,000. And you're able to get $1,250 in terms of premium just on a capital of $5,000. So that's what they did. So that is the problem, because they do not realize the risk that they actually are having. So this is number that you actually have to pay attention to. The big problem is this number right here. So you see this number says this is the max loss. So a lot of people do not even bother to look at this number. What it's trying to tell you that if the stock actually goes to zero, this is what you can lose. And if this person was to sell 5 contracts, so you take $9,750 and you times 5 contracts, guess what is the risk? The risk is, let's just take out our trusty calculator here. So our total risk is 9,750 times 5 contract, and the total risk is $48,750. $48,750, and they only have $5,000 in their account. Their account size is only $5,000. So can you see how their account can easily get wiped out because they've gotten too big of a position for their account size? So how much of a move does Amazon need to go down in order for this $5,000 to be wiped out? How much do you think it needs to go down? Well, for this, let's take a look at the risk graph. So if you were to take a look at the risk graph, you can see this is, you have 5 short put contracts on the Amazon with 100 strike price. So you can see right at the $90.84, you would have lost $5,003. So this is why a lot of people lose all their account, or they get into margin call. Right? The stock, all it has to do is drop from $100 all the way to $90.84, and that will wipe out the whole account of $5,000. So this is the problem that a lot of people have when they start selling puts, because they over leverage themselves. all they see is the amount of money that they make. They do not see the risk that they have when they sell all these put options, and this is something that you do not want to get yourself into. So this is actually what happened to a friend of mine. All right, not too long ago, a friend of mine got into trouble by selling way too many puts on Baba. Right, this is the stock of Baba at the point of time when he came to me. I think it was roughly about $170, $180. So what he did is he said to me that he sold 6 put options at $160 strike price for $5 per option. Right, so for 6 contracts he would receive $3,000, and he came to me and said, Davis, this is such easy money, you should be selling on Baba as well. So I told him that yes, it's easy money if it expires worthless, right? But if you get exercise, if the market was to calm down, then you're going to get a lot of trouble, right? The problem with what he just did is that his account size is only $25,000, right? If you were to get exercise on the full 6 put options at $160, the amount of capital you need to put up is actually this. So again, let's put up our calculator. So what you will need to get to fulfill the obligations of this put contract if you get exercise will be 6 times 160 and times 100 shares. So you need $96,000, and he only has $25,000 in his account. And the other problem is that he has actually other positions in this account. So this is only a small, or rather a part of his portfolio. So as you can see, if 6 contracts were exercised, you have total funds that you need will be $96,000. So he said, Davis, don't worry. The stock right now has already been selling off so much that it has found the bottom. He says that how much further can it go, right? It has already went down a lot. So I told him that, you never know. So most important thing is that you got to make sure that you are well funded, that in case you do get exercise, you need to put up that amount of money. He said there's no way that will happen. Well, not too long after, he actually came back to me and told me that his account is in trouble, because as you can see, Baba went all the way down to as low as around $70, 70 something dollars, and he shot all the way 160 contracts. Sorry, 6 contracts at $160. So this is a huge move down, almost $90 in a move down. So needless to say, he was in big trouble, and he was about to be facing a margin call from the broker. So he came to me asking me for help, asked me what should he do. So I told him, first of all, what happened to the easy money, right? Because he said that it was so easy and that the Baba won't come down. But in the end, it did come down. So I told him, right now, you need to do a few things, right? Number one, you could either top up more money. If you add more money to your bank account, or rather to your trading account, then you could fulfill all the obligations in case you get exercise. But he said that he didn't have that much cash. So I told him that the next other thing that you can do is to basically reduce your exposure. That means you have to cut some of these positions right here. You have, he had 6 short puts. I told him that he need to try and cut a lot of it down, as well as other positions he has in his account. So he decided to close some of these puts, and I told him for the remainder of the puts, you will have to roll it as far out as possible, maybe to the furthest expiration date, and then try to push this 160 strike down maybe to 155 or even to 150 or lower. And by doing that, you actually reduce the delta, so the impact on your account is not that bad. So at this point of time, he had no choice, but he has to take loss on some of his positions, when in the long run there could be a possibility that the market could bounce up, right? So he missed out on all this chance because he over leveraged. He decided to sell too many contracts for his account size. And this is a very important lesson for him, because if he did not experience this now, if he were to get a little bit overconfident, if he made this money on this short, these 6 contracts, next round he might start to sell more. He might sell 10, he might sell maybe even 20, and that will be a big problem next time if the market tanks again. So there's a very important concept that I like you to understand, and that is the term risky versus calculated risk. So here's the thing, when you come to trading or even investing, you cannot avoid risk. right? When you say whether is it risky or not, there is always risk, because when you're putting in money into the market, there's always a chance that you can lose it. So rather, instead of asking whether is it risky, you need to understand there is something else that's called calculated risk. So when people say selling put options is risky, that's because they don't think of the possibility that the underlying stock can go down. They only think of how much they can make, and that's exactly what happened to my friend. When I asked him, say that what happens if the market goes down, he says that he doesn't believe that Baba will ever go down because he has been oversold. So all they see is how much potential money they can make, but they totally ignore the risk on the downside. And that is why they didn't plan for the worst case scenario. If my friend had planned for the worst case scenario, he would know that there is a possibility that if his options get exercised, then he would not be able to fulfill the obligation. So he would need to reduce his size. So they don't really also understand the strategy, and they definitely didn't have a plan. Instead, we want to take a much more strategic approach, which is to have calculated risk. So calculated risk is when you understand that there is a possibility that the stock can go down, right? Every time when you enter a trade or investment, you ask yourself that there is a chance that the stock can go down. And if it does, are you prepared for it? Are you ready for it? And then you have to plan for the worst case scenario as well. So are you okay with it? So this also comes in terms of diversification, right? If you put everything into one stock, let's say, and you are saying you're very confident in it, that's fine as well if you're very confident in the stock. But if it goes to zero, you need to be able to know that this is the risk that you want to accept. So the most important thing is that you understand the strategy thoroughly and that you accept the risk associated with it. Right? And I learned this very early on the importance of calculated risk when I was working for a proprietary trading firm over a decade ago. So if you're not very familiar on the term of what proprietary trading firm is, basically where the company, they have funds, and then they hire all these traders, and then they give funds to these traders to trade the markets, and whenever they have any profits, they just give them a profit share. So I want to share with you a very quick story on what happened when I was at a prop trading firm, so you get a better understanding on the term of risk versus calculated risk. So the one thing about proprietary trading firm is that they will give money to, they will fund the accounts of the traders, and if they make money, they'll give a cut of the share. They'll give a profit sharing. But if the trader was to lose money, then the trading firm actually bears the risk. So the number one thing that the prop trading firm has to do is really manage risk, because if they don't, one single trader can easily just get them out of business, and they cannot make this happen at all. So managing risk is very important. So I remember the day when I entered the proprietary trading firm. It was my first week. There was this senior trader there. So the senior trader has been there for a number of years, and if you have been there for a number of years, it means you're very likely that you're profitable. Otherwise, you wouldn't be able to stay in the prop firm for years, because some prop firms do not actually pay a salary, and if they do, it's very little. So that is why the only way that you can really stay on is if you keep making money in the markets. So this senior trader there has actually been there for a number of years, and that very particular day when I was there, what happened was that all of a sudden the boss from his room would stand up and then come out of the room and stand in front of this senior trader and ask him what on earth is he doing. So the boss was very angry and asked him, what are you doing? Are you going to get out of the position? What are you planning to do? So apparently this senior trader has got himself into a very big position, and he has already hit the maximum loss that he can hit per day. So all of us have a risk, that a maximum risk or maximum loss, that if we hit it for the day, we have to close out our positions and stop trading for the day. So this senior trader has already hit that amount and has actually passed it. So the boss was asking him, why isn't he trying to get out of his positions? Instead, the trader was like a deer in the headlights. He was just staring at the screen, and then he just told the boss, say that, all right, I'm gonna just close out these positions once it dropped a little bit more. So the boss told him, say, okay, that is your plan, all right? If it drops a little bit more, you are out. So the boss went back to his room, and then sure enough, a few minutes later, the boss stood up again and came out, and this time he was extremely mad. He told the trader, this senior trader, to get out of his seat, And then the boss sat down in his seat and manually closed all of his positions. And you know, this is a very bad thing. When the boss have to close your positions, it means that you have screwed up. So the boss was just hurling a lot of vulgarities at him. And the thing, what happened that day is that the boss told him to pack up and leave and to never come back. So think about it this way, right? Think about this. This guy is a person that has been trading in the firm for many years and most likely has probably made quite a bit of money for the firm. And because of this one mistake he made, that he didn't manage his risk properly, and he managed to get himself fired after working for so many years. So this goes to show that the proprietary trading firm is very hard on risk. And the moral of this story is that if you don't have a plan and you don't know exactly how much you can lose in a worst case scenario, then you shouldn't be in the trade in the first place. So this, I believe, if you are investing in the market, you're trading in the market, you're using your hard-earned money, right? So if you're using hard-earned money, why do you want to get into a trade which you don't understand? You don't even know what is the maximum risk that you can have. So it is very important to plan out your calculated risk. Okay, so now that we've established that you need to know what's your calculated risk, the question is, how do you make selling put options safer? So I'm going to give you a few ideas, a few tips on how you can make selling put options safer. And the first is to ensure that you know what's the maximum risk in the worst case scenario. If you know what's your maximum risk, then you'll be able to prepare for it, right? And you have to ensure that you have enough funds to fulfill the obligation of buying the 100 shares if you get assigned. That means you do not really want to use the margin box which you see. You don't want to base, the sizing of your options, or rather the sizing of how many contracts you can actually sell by looking at the margin. Instead, you want to look at the obligation that you have to fulfill if you get exercise. Now, if you don't plan to get assigned, that means you just want to trade the put itself, then you need to know where to cut loss. Okay, so if you were to sell more contracts than your account can actually have, you need to be able to say that if the stock was to drop maybe $10 or maybe 10% or 5%, that's the point where you need to cut off, and you have to be very strict about this, otherwise your whole account will get into trouble. And you also want to avoid selling put options on stocks merely because they give more premium, right? There are people out there that are just selling put options just to get the premium, and they have no real want. They are not planning to actually get fulfilled on the put. They do not want to get exercised on a put. So the thing is that these stocks, they have high implied volatility for a reason, and because it's volatile, and if it's volatile, it means they expect a huge move, right? So it is slightly more riskier than if you were to go for stocks which have a more proven track record, all right, and implied volatility is not as high. Alright, then finally, you want to sell put options on only fundamentally good stock that you don't mind owning for the long term, or maybe even broad-based ETFs if you have the cash, for example, like the QQQs, the SPYs, or even IWM. So while there's a lot of intricacies into identifying what's a fundamentally good stocks, generally you want to find companies that are steadily increasing in revenues over time, companies that are steadily increasing profits over time, and they have relatively little debt. So if you were to compare these two companies, which do you think is a better or a safer way to sell your put options, right? Would you think it's safer to sell on Google, where you can see this is their revenue in blue, they're increasing every year, and their profits, the net income, they're increasing every single year as well? If you were to take a look at this is GameStop. If you see this, you can see their revenue is very inconsistent. Some years they are higher, some years they're lower, and look, they have not been in profit for the past 4 or 5 years. So obviously with GameStop, you can definitely get much more premium when you sell your put, right? But the problem is that if GameStop was to crash, you won't be making money on your puts in the first place, because the value of your put is tied down to the underlying stock. So if the underlying stock never goes up in the end, which is what we want when we sell the put, then you will never be able to make money on the put options. On the other hand, you may have a lesser premium when you're selling good companies, like for example Google, But in the long run, as long as the market does go up, then your put options will be in profit. And even if you get exercise, you'll be owning shares that will eventually, the stock will go up and you will make money. Alright, that's it for this video, guys. And if you like this video, please subscribe and hit the notification bell so you'll be informed whenever I release a new video like this. And as always, thank you for watching. I appreciate your time, and I'll see you in the next video.